that's one value add strategy. We do that quite a bit. Sometimes value add is management plays. So in these mom and pop type operated facilities, they're just being undermanaged. We can go in and add revenue with things like U-Haul truck rental, tenant insurance programs, those kinds of things. I would consider them low-hanging fruit of an undermanaged facility. So we can do those kinds of things, add NOI that way. And then, third is kind of a lease up value add, right? Where, maybe we'll negotiate with the seller where, hey, you take the construction risk, build out the expansion. We'll buy the facility at certificate of occupancy and our risk is the lease up. So, that value add strategy, I would say that we as an operator are opportunistic and we'll look at almost anything as an opportunity to create the value there.
Welcome to the Wealth Through Real Estate Investing Podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and to reach the lifestyle you always wanted. And now, your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing Show. This is your host, Dwaine Clarke, and today we have Kris Benson. Kris is the Chief Investment Officer with Reliant Investments. Reliant is a self-storage investment firm and is the top 25 self-storage operators in the United States. Kris, thank you so much for joining us on the show, and how you doing, my friend?
I'm doing great. Thanks for having me, Dwaine.
I really appreciate it. Yeah, one thing we've been talking a lot about self-storage lately, just kind of learning more and seeing more stuff of that in the news lately, but can you kind of talk about your start in self-storage? Why did you choose it? And a little bit more about your background, how you got started.
Yeah, mine's a little weird. My background is pretty distinct. So my last corporate job, Dwaine, it wasn't in real estate. I was actually in sales. I worked for a company called Intuitive Surgical. They manufacture the Da Vinci robot. Some of your listeners may know what that is. It's a pretty incredible piece of technology in the operating room. The company's incredible. Technology was incredible. I was super grateful to be a part of it. And so real estate was always kind of a side hustle for me until it wasn't. I started out with residential, probably like many of your listeners did, duplex, triplex, quads, realized very quickly that that was not scalable. And so I wish I could give credit to who said it, but basically somebody said to me, big deals and small deals are the same amount of work. You just make less money on small deals.
Exactly.
And so we ended up divesting of the smaller portfolio and then got into some commercial multifamily. And that's sort of where the light bulbs went off for me, where I realized this is how you make money in real estate with something that was a scalable platform. So we invested in our own direct multifamily properties. We did some passive investing with some other operators as well. And about 5 years ago, Dwaine, as cap rates have continued to compress in multifamily, and the story really hasn't changed in the 5 years since, but one of the operators I was talking with said, hey, we're going to stop buying. We don't think there's enough value in the market. And this is a group who, had over $1 billion under management. And so that got me thinking, hey, these guys are really smart. They've done a good job in the space. I should probably start looking at some other asset classes. And I'm a data guy, so I just started digging into the National Association of REIT data, which basically tracks, all the publicly traded REITs across any asset class. So it gives you a nice apples to apples comparator, right? And storage, historically, the last 25 years did just under 17%, which outperformed kind of the core four, the apartments, industrial, retail, which I thought was interesting. And then I'm a believer that everything is cyclical, and the downturn is just another cycle away from coming. So when you looked at storage through 2007, 8, and 9, it lost less than 4% of the value at the REIT level. So really outperformed apartments, retail, office. And so, when you have that historical performance and that recession resilience, the thing that really kind of made up my mind, I guess, was the consolidation opportunity that exists in storage. And even it's consolidated some, but even to this day, there's 5 publicly traded REITs that most of your listeners know about, like Extra Space, CubeSmart, Public Storage is the largest. And they have thousands of facilities across the globe. And they own about 25% of the market. And the remainder is really fragmented with different groups of owners, still a lot of mom and pop guys. And so for us, and what at the time when I looked at that, I saw that as a roll-up strategy, consolidation opportunity. So that's really how I got into storage initially. And I was a passive investor actually with Reliant first. And then about 3 years ago, I had some experience raising capital over the years. Reliant needed some help in scaling their capital markets platform. And so, we struck up a partnership, and now I'm an employee. So I've been here as an official employee for 3 years. And I'm talking to you from our office in Roswell, Georgia, which is just north of Atlanta.
Awesome. Yeah, just kind of further in commenting on the resiliency of self-storage, you had kind of mentioned looking at all the different sectors and this being performing very well. I had read a report regarding like the near zero rate of CMBS loan delinquencies, which is like I'm like, wow, like it was like extremely low. Can you kind of comment on that report and then kind of like just some more factors that really drive investors' interest into the sector?
Dwaine, did you write that report from the 2007, 8, 9 cycle, or are you talking about through COVID?
Through COVID, yeah, through COVID.
Yeah, so we're recording this, middle of December, and knock on wood, storage has performed very well during the downturn, right, or during COVID. And I think it's really rooted, so I look at that through two lenses. One, we have 52 properties across 8 states, so we're getting a small glimpse of the asset class. We look to the REITs to kind of tell us what's happening at the national level or asset class level, and what they're reporting. And everybody's kind of seeing the same thing. April, May, and June were slow. I think people are still trying to figure out, hey, if I go outside, am I going to die? And then, July through, let's say, October, and even the numbers we're seeing in November are pretty strong. People are paying their rents, right? So delinquency is really low in our particular portfolio, less than 1%, which is fantastic. It's actually lower now than it was pre-COVID.
Wow.
And I don't think that's corollary. I think it's just coincidental, but people are still paying their rents. And then secondly to that, the demand drivers are still there. So, in storage, Dwaine, we talk about the 4 Ds, death, dislocation, downsizing, and divorce. And fortunately for storage, unfortunately for the general population, a pandemic like this creates a lot of all 4, right? People are dying, unfortunately. People are being dislocated. People are having to downsize. And interestingly, I talked to a buddy last night who's a divorce lawyer in New Jersey, and he said the last 12 months have been the biggest year ever, and he's been, in the business for 25 years.
Wow.
And his point was, look, when you take 2 people who don't like each other and stick them in a place where they can't really get away, it accelerates the idea that they probably shouldn't be together anymore. So back to the storage side, or probably divorce rates, I would guess that when we look back on the COVID divorce rate, or during COVID versus post-COVID, you're probably going to see an increase in the divorce rate as well.
Wow. And then kind of talking about one of those 4 Ds, as far as like kind of correlation, is it more renters equals kind of more use of self-storage, or is it been kind of stagnant? I know we have kind of changes in the overall market, but is it more renters, typically more demand for self-storage?
Not necessarily. It's very market specific, Dwaine. And the demand of storage has been very challenging to ascertain with good statistical significance. There's been a lot of people who've spent a lot of money trying to understand what are the true metrics of self-storage that drive demand. And things like renter versus owned population, divorce rates in a particular county, like does that equal demand? And there's not been a lot of statistical significance around it. It's kind of the whole story, and each market has its own individual drivers. What's interesting, Dwaine, with self-storage is the only thing that matters is the 1, 3, and 5 mile radius, right? So, MSA level demographics, for your listeners who don't know what that means, metropolitan statistical area. So like the city level information doesn't matter. What matters is 1 mile radius around your facility, 3 mile, or 5. And because when you think about storage, right, we're selling a garage, right? So people aren't traveling for a good school district or, amenities. It's a garage. So it's either close to your house, or it's close to work, or it's convenient for some other reason. And that's why you're choosing that particular location. I mean, all other things being equal, right? If price is the same, customer service is the same, well, then you're going to pick the one that's easiest. So, I think for us, especially on the underwriting side, a huge component of this business is understanding the story in your 1, 3, and 5 mile radius.
And then kind of digging a little bit deeper in that, as far as kind of your target markets and everything like that. I know we mentioned pre-call regarding like tertiary markets. I know there's a lot of shift and movement from people coming out of the cities. So what's kind of like the ideal target market for you guys, and where you guys seeing opportunities?
Yeah, I mean, for us, and everybody's got a different strategy, but for us, we're seeing the yields in the secondary and tertiary markets. There's been a large development cycle in self-storage for the past 5 years, because of the success that I've already mentioned, right? There's been a lot of new supply coming to market. And the cost, the yield on costs have been good for ground up development. So, you have to be thoughtful of that. For us, we think the consolidation strategy still exists mostly in the secondary and tertiary markets. And so, there's some advantages to that, is if your competitive set is not the REITs, right? If we're not competing against Public and Extra Space and CubeSmart, really sophisticated operators, and we're competing against 3 or 4 mom and pop guys, we can outspend them on the marketing. We can be more sophisticated in our price algorithm tools. So, we can raise rents maybe, or grow revenues a little bit quicker than we could in other markets. So it's really balancing all of those things. And even on the exit, what we're seeing, Dwaine, is institutional capital is becoming agnostic to where the cash flow is coming from, right? So generally you're going to see, if Dwaine, you own a facility in New York City, well, that's not a good example because they're probably still getting this premium. But if you own a city in downtown Charlotte or a facility in Charlotte, and I own a facility 20 miles outside of Charlotte, generally your property should be worth more because it's in downtown Charlotte. What we're seeing is that gap is closing because capital is just trying to get into the space. And there may be a correction someday, right? Someday there may be a correction where those tertiary markets get crushed and capital goes back and says, see, that's why we invest in primary markets, because Charlotte's always going to be okay. So it's a real balance right now. But what's happening across all asset classes is a lot of capital coming to real assets because treasury yields are so low. And so with that, that drives up values across the board.
And then as far as kind of like you had mentioned, kind of like the REITs and like the larger institutional investors kind of have like a specific market share, and there's kind of like a larger gap that's for opportunities. Is there opportunities in like redevelopment of existing spaces, or is there just kind of going for, kind of like mom and pop, and then just kind of waiting for those to come up and then do kind of your typical, strategy from there?
Yeah, I mean, I think what you're asking is around like, what is the value add strategy? Yeah, so for us, I would almost put them in 3 buckets, right? And our sweet spot really is value add. We do a little bit of ground up development, right? Buy a piece of dirt, get it entitled, build a facility. We do some stabilized deals where you're literally just buying it to collect a coupon, kind of, similar to what you're doing in the triple net lease world. But for us, our sweet spot, the value creation has really been in those value add deals. And I would put them in, it's not like apartments where we can go in and put in granite countertops and hardwood floors and just charge more in rent, right? I mean, it's a garage. So, generally what I would put our categories in 3 buckets. One, value add could be, we're actually building a facility, like additional facility, right? So, we're building another 20,000 square feet of climate controlled units. And the value add is building the building, getting people in it, and growing NOI, right? And if we can grow NOI, then our values, assuming cap rates stay the same, and our values go up. That's one value add strategy. We do that quite a bit. Sometimes value add is management plays. So in these mom and pop type operated facilities, they're just being undermanaged. We can go in and, add revenue with things like U-Haul truck rental, tenant insurance programs, those kinds of things. I would consider them low-hanging fruit of an undermanaged facility. So we can do those kinds of things, add NOI that way. And then, third is kind of a lease up value add, right? Where, maybe we'll negotiate with the seller where, hey, you take the construction risk, build out the expansion. We'll buy the facility at certificate of occupancy, and our risk is the lease up. So, that value add strategy, I would say that we as an operator are opportunistic, and we'll look at almost anything as an opportunity to create the value there.
Yeah, you definitely share some great nuggets there. Because, like I said, I'm starting to learn and kind of dig more deeper, having more conversations with investors and hearing what they're doing, especially with the market changing come 2021 and things like that. You guys doing a tremendous job there. So I appreciate you sharing that. But to kind of learn a little bit more about you, can you take us through as a chief investment officer, a typical workday for you, and do you have any special morning routines?
Yeah, so as the CIO here at Reliant, there's really kind of two main components to my role, right? So one is the capital market side. So any equity that we're raising, investor relations kind of rolls up to me. And from a sales perspective, that's really my bailiwick. So I'm spending usually a lot of time on the phone chasing equity. Dwaine, we're deploying between $40 and $50 million a year in equity. And so, we're constantly cycling investors. And a majority of our equity is raised through the retail investor network, right? So, guys like you and me who maybe have a little extra capital to deploy in the space, accredited investors. So we're doing a lot of those types of conversations. And then, the second part of my job is on the acquisition side, working with our acquisitions team on strategy and what we're buying. We have an acquisitions team that's underwriting, 24/7 is probably too strong a word, but everything and anything, we'll look at anything. And so those acquisitions guys, we're trying to put together a strategy that fits with how we're trying to deploy capital right now. So like right now we're raising equity through a fund vehicle. And we're trying to build that acquisition pipeline to fit into the guidelines of Reliant Self-Storage Fund 2. So that's, day to day, it's usually built around talking on the phone a lot, especially during COVID. I'm really good at Zoom meetings now.
Yeah.
like all of us probably are, because certainly the travel's gone out the window. And then the morning routines for me, the big one is working out. I grew up playing a bunch of sports, and my day doesn't feel as good if I don't start with a workout. So I used to be a CrossFit guy, but I can't understand how they're making that safe with COVID.
Mm-hmm.
I've been working out of my house, but yeah, generally if I can start the morning with a workout before going to work, it makes for a better mindset for sure.
Awesome. And then are you using any like tools or resources that help you kind of make your day more, manageable and more effective?
You mean from a business productivity standpoint, or just
Or
kind of
for personal, like journaling or scheduling and things like that?
No, I've tried to do journaling. I don't do it consistently enough. My wife's a big journaler, if I don't know if that's a word or not, but I've tried, meditation. I've tried journaling. Occasionally, I'm very much a fair weather journaler.
Mm-hmm.
I don't have the commitment that I need to either that or meditation. Usually for me personally, I'm a list guy. So, in the world of technology, the legal pad is still my baby.
The old school always works, so you have to go back. It never fails you.
I like writing things down and crossing them off. So, for me, that's essentially how I organize. And then, the normal stuff that everybody, Outlook calendars, those kinds of things. But no, nothing special. I'm kind of a meat and potatoes guy. I'm not tech savvy enough to let it take over my life.
Awesome. Yeah, appreciate you sharing. The reason I always ask, because I always like hearing what other successful people there, and a lot of times people are kind of like modeling and hearing what other people have to do. So, but yeah, with all your success, you have a great backstory, great career, and like I said, Reliant is, like I said, one of the top investors in the country. What can you say that you're most grateful for?
Yeah, that's a great question. I mean, I think at the highest level, right, it's health. When you see, COVID or non-COVID, but we've all been affected by friends, family who've been affected by chronic illness and things that cut people's lives too short. Ultimately, without that, the rest is somewhat irrelevant, right? So I'm grateful that I have good genetics. My dad's 77 and in great health. My grandparents lived a long time. So I got good genes, not a lot of chronic illness in the family. And I've done my part, I think, to continue to take care of that. And then I think, you know, the day-to-day stuff, Dwaine, like I'm blessed with a wife who's super supportive of, you know, my endeavors and what I'm trying to do. And, you know, without that, it would be really challenging to manage the rest of our lives. You know, I hate to sound cliche and say I'm grateful for, you know, health and family, but it's hard to put things above those two.
Exactly.
You know, and then I would say from a, you know, just overall work perspective, I'm grateful for like the opportunities that have been presented to me over the years. And, you know, I've taken my part and jumped at many of them, but, you know, I think a lot of people put themselves in a position where they're not willing to jump, and opportunities present themselves. It's just a question of what you're willing to do with them. And it's not always easy. I'm not saying I'm a brave, intrepid explorer and I'll jump at anything, but you know, there's certainly people in this world who want lives to change, but aren't really willing to do anything about it. So
Absolutely.
You know, you can't really expect the outcome to be different. So I'd put them in those three categories, I think.
Absolutely. Yeah, I appreciate you sharing that. And then we'll make sure to have all your contact information in the show notes blasted on our newsletter and all our social media feeds. But is there any contact information that you're willing to share with the audience today?
Yeah, sure. I mean, I think if you're interested in Reliant and the investment platform side of things, may have interest on the investing side, ReliantInvestments.com is a good website where, you know, we have our most recent fund and track record information, meet the team, the usual type stuff there. I'm on LinkedIn fairly frequently. We're posting, you know, content relatively frequently there. So if people are just trying to reach out to me, you can certainly reach out to me that way, and happy to get in touch.
Awesome. Kris, it was a pleasure speaking with you. I appreciate you taking the time, especially during the Christmas holidays and everyone's kind of getting busy with family and things like that. So I appreciate you carving a little bit of time for us, talking more about the self-storage industry and why we all should be looking more into that asset class. I know like our audience, we're just so diverse and looking at other different types, but really bullish on self-storage and really definitely should have a conversation with you on that. Kris, I really appreciate it. All the best to you and the family, and look forward to connecting with again soon.
Sounds good. Thanks, Dwaine. Have a great rest of the day.
All right. Thank you. Take care.